Okay, our last section in chapter 19 is on buying intangible assets and then calculating their amortization expense. So, up until this point in chapter 19, we've been talking about tangible assets or long term assets such as cars, buildings, equipment, things like that, things that have a physical presence. Intangible assets are assets that do not have any sort of physical substance. And examples of these include patents, copyrights, and trademarks, or similar items along that line. The thing you have to remember about intangible assets is that their value comes from the rights it gives um, to whoever owns that patent or copyright or trademark, not from the actual piece of paper that says that. So it's actually the rights that are valuable, not necessarily a physical piece of something. So when it comes to intangible assets, sometimes they're very easy to determine a legal life, we call it, and sometimes we have to determine what would be useful for them. In the situation that we're working with, we're going to work with a patent, and patents have very easily determined legal lives because, according to the information, they have 20 years where no other company or individual can copy that product. However, after those 20 years are up and the patent expires, any individual or company can reproduce and sell that same product. So it's actually the right to not have any other company or individual copy. That's what is of value when we're talking about intangible assets. So when we record the buying of an intangible asset, it's very similar to the way we buy any other asset, whether that's supplies or prepaid insurance or a long-term asset like a building or a car, any of those things. So our example that we're going to work with for the rest of this section is that our company wishes to buy a patent from another company, which you can do. And the patent's legal remaining life is 14 years. So they've clearly held the patent for 6 years, and it has 14 remaining according to that patents have a 20-year legal life. However, our company feels that the patent is only going to be useful for 10 years, and after that, new technology is essentially going to reduce our patent's value to zero. So when we actually go ahead and record the buying of this intangible asset, our patent goes up, that's our intangible asset, and cash goes down with a credit. That's going to be in our cash payments journal. Patent goes in the account title, check number, debit, and then cash credit. Now, we do not do depreciation with an intangible asset. Instead, we do amortization. Amortization is the spreading of the cost of an intangible asset over its useful life. Now, amortization is very similar to depreciation, except that depreciation only applies to physical assets. So since a patent is an intangible asset, we have to do amortization. Some intangible assets have a legal life, like the patent. If an intangible asset has a useful or legal life that can be determined, then we do need to make sure that we amortize that asset instead of just keeping it there as at our original cost. Now, amortization is based on the estimate of the useful or legal life of the intangible asset, whichever is less. So remember that right now, the legal life of our patent is 14, but we estimate that it's only going to be useful for 10. Unlike depreciation of a physical asset, there is no estimated salvage value when we're talking about an intangible asset, so it will just be reduced all the way to zero. Amortization is recorded as an adjusting entry each fiscal period until the value is zero, which is something a little different than our depreciation expense. So just keep that in mind. So remember that for our example, or from our example, our patent will expire in 14 years. However, a company feels that the new technology is going to render it useless after 10 years. So since the 10 years is less, that's the one we will use when we calculate our amortization expense. So we take our original cost. There is no salvage value with amortization. So our total amortization expense is $45,000. We then divide that by the number of estimated useful life years, and we get $4,500 a year. Okay? So when it comes to doing adjusting entries, What we do is we debit our amortization expense, and then we actually credit directly into our patent account, which will give us a new balance here of 40,500, which also is a little bit different because normally with tangible assets or our regular assets, we have accumulated depreciation accounts for each one, and that is not something that we have with a patent. It goes directly into that patent account. Okay. So, like I just said, the balance of the patent account is going to represent the cost of the patent that has not yet been amortized. That's something that's different. We don't have accumulated amortization expense. That isn't a thing. And intangible assets are going to appear on the balance sheet usually as one of the last categories of assets. You'll see current assets, long-term assets, and then intangibles usually at the bottom of that. And then amortization expense goes on the income statement, and that is one of our operating expenses. So just that information will probably make its way into like a study guide or a test situation. So just so you're aware. All right, we're ready to head over and do our last 19.6 work together. And we'll meet you over there.